All right, well, Friday's jobs report showing an uptick in unemployment for the month of October. It was seen by economists as a better signal for the overall employment market than a strike-impacted headline number. The big picture for investors now, with higher for longer rates on the table, some may be looking to a different corner of the market. Small caps. The Russell 2000 is up nearly 2% in the last month. Our next guest saying that small cap balance sheets could be in better shape than investors feared and tend to price in economic problems ahead of time. We want to bring in Lori Calvasina, RBC Capital Markets head of U.S. equity strategy, joining us now. Lori, it's great to see you. So let's step back just a bit here. You're seeing some opportunity in small caps. What's the investment thesis there? Why do they look attractive at a time like right now?
Well, thanks for having me as always. And I think you start out with the valuations. If you look at Russell 2000 valuations against S&P 500 PEs, we're basically at the lowest level we've seen since the kind of 99, 2003 type era, so the tech bubble era. And that's causing some multi-asset investors to take notice. The other thing about small caps is that you typically want to buy them midway through a recession. They tend to lag late in an economic cycle. And so there's really a sense that when times get dicey economically, that's when you want to go bargain hunting in the small cap space in particular. Now, I will tell you, my conversations with investors, all of it the last couple months has really focused on balance sheets. And so we've been spending a lot of time walking investors through how, just like the large cap companies, small cap companies have really paid down their shorter term and variable rate debt. They still have more of it than the big cap companies, but just like the large cap companies, they've really pivoted towards long-term debt that they've locked in at very, very low rates. So they're benefiting from the era of low interest rates a bit longer than many investors have realized. And so we think the balance sheet bite really isn't as bad as feared for these companies right now.
Lori, in your notes to us, you say that growth sectors are typically the biggest beneficiaries of declining 10-year Treasury yields. I wonder, though, if we do see some type of kind of step off of the gas, or if a surge in yields stops soon, then what?
So we actually went and looked at the history. And if you look at in the past, in both rising rate cycles and falling rate cycles, so we went all the way back to the 60s, frankly, we found that the equity market can weather increases in the 10-year Treasury yield up to about 275 basis points. And at the peak that we'd seen earlier, or I guess last month now in October, that was really kind of in the 160s. I forget the exact number, but it really wasn't anywhere close to that level that tends to produce declines in the equity market. Now, the surge in yields that we saw in 2021, 2022, that was over 300 basis points. So that is in line with the kind of moves that we tend to see. We've seen historically that if your move in Treasury yields is more than 275 basis points, that's when stocks tend to fall. So I think that if the equity markets really get convinced that we've seen the peak in yields, and I will tell you, based on the conversations I had with investors last week, a lot of people are hoping that that's the case, then I think equity markets, it's a good chance we've put in the bottom. If that rise resumes, then we're going to be in trouble. But if we top out around 5%, the history says equity markets can handle this. And given the weight of the big cap growth stocks, that should augur pretty well for them as well.
Lori, you just mentioned there some of the chatter out there right now about yields. Do you think we've seen a peak in yields?
I'm an equity strategist, not an interest rate strategist. I will tell you that the rates community, I think, didn't necessarily have a great handle on why we had seen that yield surge that happened and why it happened as quickly as it did. If you look at the consensus forecasts around the street, they are still looking at the end of this year, at the end of next year, for yields to move lower. Now, we have seen a really strong ratcheting up of year-end 2023 forecasts on the 10-year. It was around 3.5% over the summer, and frankly, for much of 2023. And now if you look at that expectation, it's around 4.5%. So I would say the people who are smarter than me on this issue have recalibrated their forecasts, but seem to be settling into the idea that they'll move a little bit lower from the peaks that we've seen recently.
What is the top equity market idea? You mentioned small caps earlier, but if you're kind of going bargain hunting, or maybe on the other side of that, maybe you're looking across some of the valuations that you're expecting to come down, especially given the fact that the Magnificent Seven have driven so much of the equity market surge in the S&P 500, at least over the course of this year. Is there a reset that we're due for at some point?
So I think that the growth trade, it's just in a really, really strange spot right now. If you look at growth stocks relative to value stocks, they've been overvalued. If you look at a market cap weighted multiple, CFTC data suggests that the growth trade is still very crowded. On the other hand, growth stocks tend to outperform when the economy is sluggish, and consensus forecasts on the economic side are calling for, I think, about 1% GDP growth next year and 1.8% in 2025, and the long-term run rate is about 2%. So economists expect that we're heading into this sluggish economy, and typically growth stocks outperform in that environment. So they're kind of these near-term tactical problems that have to be resolved. But at the same time, that longer-term fundamental appeal for the growth stock is very, very strong. My way of approaching this is to have a bit of a barbell approach. Some people have called it a tri-bell approach. I want a little bit of defense. I like healthcare for that. On the value side, I like energy. But on the growth side, I will tell you, I'm still recommending the technology sector. And one of the things that caught my eye last week is that if you look at a median PE for the S&P 500 tech sector, which doesn't reflect the Magnificent Seven, but really reflects what's going on elsewhere in the sector, you're basically back down to the average on both an absolute and relative PE multiple. So I think value has been unlocked in the tech sector, even if those bigger cap, mega cap names in the tech space still have some problems.
Lori, how much has the sentiment, do you think, shifted already here in the month of November? We're only 6 days in, but certainly we are seeing more of a bullish type of outlook here between now and the end of the year. Is that something that you see sticking here for the next several weeks?
So, I'm a little bit of a data nerd, and I will tell you, we had something really exciting happen on one of our models last week that we've been waiting to happen for a while, which is that if you look at the AAII net bull bear ratio, just net bullishness, so the bulls less the bears, it went down to 2 standard deviations below the long-term average last week on the weekly data point. And we tend to look at a 4-week average because there's a lot of noise in that. And that 4-week average went down to about 9% in favor of the bears. And that's about a 1 standard deviation move below the long-term average. And typically, when you're at 1 standard deviation below the average on that 4-week average, stock market's up about 14% over the next 12 months. Does that mean that we've necessarily put in the lows, that we're completely out of the woods? No, we do often see that 4-week average go to the 2 standard deviation mark, as it did last year around the October lows. But this is certainly something that, as I look into next year, makes me feel a lot better about the longer term path for equities.
And then when you think about some of the other indicators that you're going to be tracking going forward from here, I mean, some of the high frequency indicators that you've also been keeping tabs on, what should investors kind of be keen to there?
I mean, there's so much that we can watch. I would say that I'm also looking at the CFTC data very, very closely, kind of going back to our small cap conversation earlier. The net positioning among asset managers for Russell 2000 futures has been down around SVB lows. It has not hit recession type lows that we saw in 2022, but certainly we got to an interesting, sort of level there as well. So we'll be watching that to see if it breaks, and if it does break, when it gets to that 2022 levels. But if it starts to heal, I think it deserves that move. I think the other thing, I really would like this valuation froth and crowding to get out of the Magnificent Seven, to get out of that kind of broader growth space. And so we're watching the CFTC data on NASDAQ 100 minis futures positioning, again, among the asset managers. And that, frankly, it's caused trouble for the broader market a few times in recent years. It's kind of hit the recent highs that we saw last August as well. It's been very slow to roll over. So I would really like to see that one just collapse, frankly, so we can kind of get this crowding argument done and over with.
Yeah. Lori Calvasina, RBC Capital Markets head of U.S. Equity Strategy. Lori, great to begin the week here with you. We appreciate the time and insights. Thanks.